What we did last time, we looked on USSW, okay? And this is kind of the major screen that we're having. And so here, right, we said this is going to be the government. This is going to be the government. This is going to be the government. This is the index, right, which is kind of the, this is the index which is kind of the, what we call the benchmark for all the loans and mortgages. This is the index. So for example, this is called SOFRGV, and you can see that it's actually below the government rate. Now today, this government didn't move, right? Some of them moved. So when it moves up, it's red. Why it's red? Anybody can tell me? Why when it moves up, it's red?
Because you lose value.
The value goes down.
Exactly, right? You lose value when interest rates go up. That's why it's red. And here, right, this is the futures. Now, let's talk about the Treasury futures. So we want to see TMH. Treasury note. DYA, yeah, DYA. Okay, so when we trade fixed income, lady boss, right, you ask me how you trade fixed income. Most of the people that are actually trade fixed income, they actually trade what we call fast and furious, right? They don't use bonds, they use futures. You know what futures are, right? So futures is basically a certain bond that you need to deliver on a certain time, okay, for a prescribed price. So if I'm buying a future, I have it's not an option. I'm obliged to give the money. If I'm selling a future, I am obliged to produce a bond. Okay. The bonds that we have now here, okay, the most frequently traded future is this future, which is called the Treasury note. Okay, and if we look on its description, so we have the future contracts table. CT is going to give you the future contract table, right? So here's the future, which actually expires in June. This is the future with TYM. Now, if you want the future that expires in September, it's going to be TYU, right? So what you want to do, if you want to go to the future, you do TYM, right? 6, and you can see that it actually appears here, TYM commodity. Okay, and here, if you want to see how it looks like, you go to security description. Okay, so this always will tell you, right, what are the specification for a future contract, right? For a 10-year future, you see that the contract specification, first of all, you need to actually find the underlying bond. The underlying bond is a US 10-year 6%, right? So what does it mean? That under this contract, you're obliged to deliver, quote unquote, you're obliged to deliver a 10-year bond which expires in 10 years, right, with 6%. So if the future expires in June 26, okay, by this kind of logic, right, you need to deliver a bond which is a 10-year bond that expires in June 2036 with a coupon of 6%, okay? Whatever the price of the bond is. Now, what is the price of this bond? You see that the price of this bond is going to be on $100,000 USD. This is the contract size. This is the principal of the contract. It will be 110, 640, 63, or per 100, this will be this. 100.20 plus points, which is 6.4. So 20, I think, is 6.4, and then the 63 is a plus. Okay? Now, when are you going to deliver it? You see, the first notice is on 29th of May. and the first delivery on the 1st of June, but you have a month to deliver the bond. You see, the first delivery on the 1st of June 2026, the last delivery is on the 30th of June 2026. So you have a bond, you have a window of 1 month to deliver this bond.
Sorry, what is the notice for? If like you know when it should be delivered?
It's all formal, okay?
Okay.
It's all formal.
Yes, to be
Everybody
legal,
know,
I understand.
but this is part of the future. This is part of the structure of the contract,
Yes.
right? This is part of the structure of the contract. It has to, right? And the part of the structure of the contract that you have first notice. So the broker, right, will call you. You are a seller,
Yep.
and you will say, hey, you need to deliver
Yep.
a bond, right? Now the question is, what do we want to deliver? Do we have US 10-year 6% bonds in the market? Do we have a 6% bonds in the market?
Don't think so.
Not yet, right? If we want to find the 6% bonds, okay, we'll do it later. So what can you deliver? What you want to deliver, right? You do DLV. Like this.
So there is no option here, the cash settlement, right? It has to deliver the bond.
You have to deliver, but the question is, what do you want to deliver? And you see that on this contract, the seller can deliver any one of these bonds. So the window to deliver these bonds are the bonds which expire, which mature between 6.5 years to 10 years. Okay? You see that here, the last bond that matures is going to be 15th of May 34. So you can deliver any bond between that matures in 6.5 years, so it matures on 31st of January 33, until bond which actually going to mature like in what, 8 years almost, 15th of May 34. So even though it's a 10-year treasury note, you can deliver any of these bonds. Now, which bonds you will deliver from the point of view of a seller? Which bonds you will deliver? If you have, let's say, 10 bonds or 11 bonds to deliver, which bonds you will deliver?
Good evening, Professor.
Which bonds you will deliver?
Whichever is cheapest for you to go.
Exactly, right? And the cheapest to deliver is this one.
96.
Yes. You see, there's a price. And now how much you want to deliver? Because you see this bond, the yield, right, is going to be 4.17%. Okay? You need to deliver 6%. If you deliver 4%, a bond with 4%, so if we go here, we click on this bond, okay, we look on description, let's say, this bond, okay, has a coupon of 4%. So if you deliver, let's think about that. So you deliver a bond with a 10-year bond, right? Which has 4% coupon instead of 6%, and I'm a buyer of the future. Do you think I like it? Why not? What do I lose?
2%.
2% per year, right? So how to solve this?
Just 50% more.
Exactly. What you want to do, you want to increase your face. So if you go back to TYM6 commodity, TYM6 commodity description, you can see, and you do DLV, so you do DLV, the cheapest to deliver DLV. Okay, what you want to do, you want to increase the principal. By how much? You take the 100,000 and you divide by the conversion factor. So the conversion factor dictates how much of this treasury future, of this treasury bond you will deliver. So you can see here that you need to, so if we have Excel, or R, we don't have R here, we have Excel probably.
Yep.
100,000 divided by 0.89, you will deliver $112,000 of this bond.
Sorry, what was the 0.89? That conversion?
You see
factor?
the conversion factor,
Oh, okay. I just might.
which actually tells you how much of this you want to deliver.
Oh, because it calculates for 6%. Actually.
Exactly. So what it does, it adjusts it
Yeah.
for 6%.
By the way, stupid question. Why is it not like 50% more? Like.
Why is it? No, it shouldn't be 50% more. You can do a simple calculation, right? That it's 2%. It's 2% per year,
Yeah, but it's 4% the coupon.
and this is a 6.5.
Oh,
So
6.5.
So 2 times 6 is what? 12%, more or less. Okay. So.
But
And on top of that, right? On top of that, remember that this 12,000, you have 4% out of that, right? So you have a little bit more. Fuck, it's a piece of shit. It was piece of shit and it will always be piece of shit. Okay, so instead of, I see, because it's 100,000, not 10,000. So you have basically $4,000, right? You deliver per, if it's 100,000, 4%, right? But because you have more, you actually have a coupon of 4.5, right? So you have 0.5%, so you have 50 basis points that you deliver through the 6 years, or 6.5 years, right? So it's going to be 50 basis points times the 6.5. It's going to be like 3 or 4%, plus another 12% that you deliver at the end. So overall, you adjust it for 16%. You see how it works? Because you have also to take into account the extra interest that you are going to get in,
Understand?
right? So it's not just the principal at the end, but it's also the interim interest, the interim coupons that you collect. You will collect more because your face is higher.
That's it.
So both of these things, right, compensate for the fact that there is a differential in interest of 2% per year.
Understand.
That's how it works. Is this clear? Is this clear? Is this clear, lady boss?
But how you know like the
The conversion
rate
ratio,
is for the
they
6%?
basically give it to you.
It's calculated.
It's calculated.
No,
So what
no,
they
no,
do,
my question is like how you know that it's matching for to calculate the difference between 4% and 6% on the.
because
Is it the only bond for 6%?
no, they actually do it in order to basically adjust, because they cannot deliver the 6%, which is not there. So what they do, right?
Yeah, but
they
my question is like only the 6% is like the bond trading here on.
no,
Oh.
all these bonds are traded. The 6% is not existing.
So you have to deliver 6%, and it offers this one, which is a substitution,
Exactly.
which is less than 6%, and it calculates for you how much you need to deliver
Exactly.
to match the 6%.
Exactly.
So these are not 6% ones.
Or
They
it
are
already
less.
designed to matching with
Yeah,
the
that
6%.
so they offer
Yes.
what you can deliver, what
Exactly.
eventually matches the 6%. That's why you
Exactly.
have the conversation. So
Exactly.
they're only giving you the options. What
Exactly.
works.
Exactly. And you can see that those are below 100, right? Because the treasury now is 4.17. You see the convenience yield. The yield is 4.17 for it.
So 0.17 is the difference. That's why it's less. Something like that.
Yes, because it's 4% here,
Yeah.
it's 4.17, right? So when you take 7.5 times 17 basis points, this is going to be the adjustment in price, give or take 7 times 17 basis points, 10,000, right? So it's 1.19 less, and you can see that it's 88.31. So you can actually click on that and see what the price of this bond. That it's actually probably will be close. So it's going to be 100. If I would guess what will be the the price of this bond is going to be 100 minus 1.19, so it's around 98.81. Do you see how I did it? Right? I use duration. I know that the 10-year duration is 7.5, so I multiply by the difference between this and 4 as a coupon. Okay, because if coupon is 100, it's a par. So if you multiply, you will see the difference, right? And you just multiply by 100, you find the dollars, and you subtract and you get the answer. Is this clear? So you know, you do it mentally in your head.
Put the trash bag, trash
No.
bin there. The trash bin, put the open. If you open, put the bin there in front of the door. The bin, the blue
bin.
bin.
No,
You
no,
cannot open, it
it's a
doesn't
blue
work. The door is
blue
bigger than
bin.
the frame. The bin, move the bin. Christian, move the bin.
Nice surprise. Okay, so this price, if you look, we can actually, maybe we can do this here, no? Can we do it here? Probably if we can go here. And we do description. We should be able to see the price. So if you don't see the price here, you do FLDS, which will give you all the fields. And here, right, you can actually do price. Latest price. Or less trade, less price, right? So, yeah, 99. Probably it should be less. It's 98.81, right? So, let's see, less price is this? 199. Okay. I said 98.81, so it's pretty close. Okay? So we go back to TYM. Commodity. Okay, so, but it's not the only one that we can deliver Lady Boss, right? So if you go to DLV, any of these bonds can be delivered. We don't have a bond, right, which matures in 2036, I think. That's why we do not have a bond that we can deliver, which matures in 2036, in June 2036. Okay.
So no 10-year bond.
Well, there are, but it might be that they mature later, right?
Okay.
And maybe the Treasury didn't, because now, United States is going to become the gas station of the world, right? Maybe we won't have to issue so much debt because
You mean reducing the options? That's what you mean.
what do you mean? No,
Reduce it.
Borrowing in terms of borrowing.
yeah, we don't. Yeah, I think that looking on these Gulf countries, United States may actually go the other way now because now instead of going to the Gulf, all these guys are coming
So
here.
that means there will be more bond will be issued.
No, less
Less
bonds.
bonds,
Less
so
bond?
yeah,
Probably.
so less.
Yeah, because just from the tax revenues of this,
Oh,
this
okay.
this is crazy tax
Okay.
revenues. It will be insane. I don't know if we'll get a balanced budget, but we'll the deficit's already
Reduce.
dropped.
Yes, it's dropped.
Yeah, and it will drop further because of this brilliant move to shut down the Gulf. Okay, so is this clear? Now, what kind of futures we have, right? So, if we go to TYA, we want generic first. We want to see, right, which futures contract table. We want to see right. So we have 3 of them are traded. You see that the December is not traded. So June is the most active one. You see it's TY1, it's TYM. This one, it's TY2. So if you want to actually click on it, it's description. These are basically what they call generic contracts, no description. It's TYU, you see? It actually expires in September, right? And you can see the contracts. TYM expires in June. TYH expires in September. TYZ expires in September. You see, so it's three months things. TYU expires in June. Okay, so you can see so if I click on all contracts, you can see exactly, you can see how start date and end date, right? So each contract is quarterly. So for example, TYM starts in 22nd of December. It's date range. No, I want its, I think I want this. Let's see. TYC. I want to know. Okay, so TYC, for example, 26. TYZ 6 commodity. This one will expire, right, in December. So if you go to description, security description, you will see that it expires in December. So you basically have quarterly, right? So here you can see exactly the contract table. So you have quarterly, the futures are quarterly, right? So you have the March, which is actually TYH. Then you have the June, which is TYM. Then you have the September, which is TYU. And then you have the December, which is TYZ. So for example, next year, with God's help, if we will all be, well, not you, but when I'm going to show this workshop to somebody else, right, it will be TYZ 7. It will expire in, and then when you hit 2030, lady boss, the clock starts again, right? TYZ 0, TYZ 1, TYZ blah, blah, blah. Okay, is this clear? Good. Okay, so, all right. Any question on that? No, okay. So now we want to go, let's see if we can get options on Treasury futures. I think it's on. Yeah. Let's say this one. Yeah. So these are the futures, I think, of the option pricer. Yeah, here. So this is commodity derivatives. Hopefully it will. No? It's not supported, so let's say option valuation. Maybe I'm on, let's see. Oh. So these are the options, right, which are available. These are options on futures. Okay? This is a strike, right? So how does options on future work? I don't know if you guys, I didn't do it in class, but is this clear how it works?
Yeah, there is a strike price. Yeah, there is a strike price.
Yeah. So you have the option to enter into a future, right? With a certain strike. So if you're a buyer of a future, if you're a buyer of a future, right? You want, are you bullish or bearish on the market? If you're a buyer of
Bullish.
No, you're not.
I mean, I
Because
assume
what
that
happens with interest rates?
yeah, it's opposite. But in general,
Right,
if I buy a
exactly.
product, then I'm bullish on the price. Yeah.
Right. So you think that interest rates will drop?
Yeah.
If you want a whiteboard, I can bring it to you here.
But where?
In this room.
Oh, really? Okay. It'd be nice. Thank you. Okay, so now we want to look on swaps, right? So Lady Boss complains all the time that there is no intuition, just calculations. So let's look on swaps, Lady Boss, so that you will be happy. So, US swaps. Okay, here we go. USSW currency, SIM card. Currency. All right, this is God's eye, Lady Boss, right? Security description. So it's USSW.
The white board is right.
Is it going to enter, Christine?
Yeah, it was here before, so must.
Thank you. Thank you.
They just stole it.
No offense, but this campus looks like, like the Happiness Bazaar, but not a university, but I'm not the one that running this campus. I can't tell them what to do.
Thank you.
So, okay, so here, how the swaps are working. So the effective date of this swap, when we actually start, okay, so how do we get to the swap? USSW 10. So for example, if you want the 10-year swap, is this. Okay, and then you go to security description to understand how the swap works. So the effective date of this swap, right, is going to be the 5th of May 2026. The maturity date, right, is going to be the 5th of May 2036. The term is 10 years, and the discounting is what you actually going to pay if you're a payer, not a receiver. If you are a receiver, right, you pay floating. So the discounting is OIS what according to what index you are going to pay. Okay. Pay frequency is semi-annual. So you're going to write a check every half a year. And remember that on the test, I'm going to ask you about this, about the implied rates of the swap. Okay? The business adjustment, okay, the adjustment, and now these are 360, right, is how you actually count the months. Because you have to actually calculate interest rates for payment. So do you take, so the actual, do you take it 30 days a month, 31 days a month, all this stuff, okay? Pay delay, 0 business days. Lady Boss, if you're not going to pay the swap, right, you're going to get a margin call. You are going to be called and said, Lady Boss, you're a bad Lady Boss. You need to pay. You need to pay the money.
By the way, what's the consequences if you don't fulfill that margin call?
What is the consequences if you're not, if you're not
Satisfied with margin call?
satisfied margin call for future? The same story, right? They will just liquidate your portfolio and will take over the money. Remember, okay, that when you enter into these contracts, okay, you actually pay a down payment.
Yeah. So you use a
So
collateral.
you put a collateral,
Yeah.
either cash or securities,
Yeah.
right? So it can be, for example, treasuries. You can put a collateral, okay, and if you're not going to fulfill the payment, you will get a margin call.
Yep.
Okay, makes sense?
Yeah.
Good. So, good.
Okay, Professor, just
Yes.
a quick one. Say in the swap contract, you have the fixed and the floating.
Yes.
You know the floating is based, let's say if it is based on the SOFR.
Yes.
So how will you be able to determine that one?
The fixed?
Yes. No,
The fi-
you have the fix.
Well, you remember the formulas that I gave you,
Yes.
right?
Yes.
The floater, right,
Yes,
is
the
based on
floater.
SOFR.
Exactly.
So you know the SOFR for, let's say, So when you are actually going to pay, you know the SOFR now,
Yes,
right?
yes.
Say the SOFR is 3.5%,
Yes.
which means that in half a year, right, you need to pay. So you need to pay 3.5%.
Yes.
Divided by 2, 175%.
Yes.
Let's say your principal is 10 million,
Yes.
right? So 175% of 10 million is going to be 175,000, right?
Yes.
So payer, so receiver sends to payer 175,000. Okay? Okay, this is at half a year.
Yes.
Now, so this half a year. Now at half a year point, you will have another SOFR,
Yes.
right?
Yes.
So you will be able to determine here
Okay.
what is the next payment.
Okay.
However, you have the implied payments, right?
Yes.
The implied payments is when you actually stand here. Okay, you know that in half a year you know exactly what you are going to pay, but in 1 year you have a problem
Yes.
because you don't know what will be the rate here.
Exactly.
But you have the implied rate,
Okay.
right? You have the forward rate, half, right? And you calculate it using the magic formula y1 t1 minus y2 t2 divided by t1 minus by t2 minus t1. This is 2, this is 1, and this is half a year. Right?
Yes.
That's how it works.
It's okay.
Right? So you have the implied payment to make the swap to be market value of 0, right? You know exactly because you are going to pay the forward rates, quote unquote. As of today, the curve will actually dictate what you are going to pay
Yes.
with the forward rates,
Yes.
right? However, you will have the actual payments only when you are going to come here, right? So it means, for example, what will happen in half a year, we don't know. Either we're going, let's say we're going to have two binary, let's say we're going to have oil at 200, right? What we're calling going to be demand destruction, okay? This guy will be higher. It will be higher than what you are going to pay now, okay?
Okay.
If, for example, this situation will resolve itself and the SOFR, the half a year SOFR will drop, then you will pay less, right?
Yes.
So you, as a receiver, you also, right? But as a receiver, you're actually taking a bet from a payer's perspective, right? You want to, as a receiver, you want the bond, you want the, you're getting the bond, so you basically want the rate to go down, right?
Yes.
Right?
Yes.
So when you are actually a receiver, you're actually making a bet that that the rates will go down because you are actually getting the fixed coupon.
Yes.
The only way for you to make money on a fixed coupon is when the rate will drop. And if you're a receiver, right, you're actually paying the bond. Okay, so the only way for you to actually make money, okay, if rates will go up, because then either the bond price will drop or you'll be able to actually make money on the differential, because you can be, you're paying fixed,
Yes.
and now you are going to get fixed,
Yes.
and if the fixed is which you're going to get is higher than the fixed that you are actually paying, right, then you are making money.
And then is it possible for the two parties to either net off? So net off the two parties, between the two parties. Say you
No,
have
you
the
cannot
fixed-
make one of them will make money, another
Yes,
one will
which is
lose.
actually so at the end
Yeah.
of the day, either one make money,
Exactly.
the one lose. So my
Exactly.
question is it possible for them to just net off and say, give me my difference?
Well, it's then you actually want to get out of the contract.
Okay.
If you actually do that, right, it's basically like if you are in the middle. This is a receiver,
Yes.
right?
Yes.
Let's say that you are actually a receiver, and the rate drops.
Yes.
Then you want to get out of the contract, right? So you are actually finding an offset contract. But you can actually, instead of that, you can actually do what you are actually saying, right?
Okay.
That you are actually can net it out.
Okay.
If they want to, they can net it out,
Okay.
right? But usually they will get out like that.
Okay.
So you may actually get 10-year swap, and you're
Something.
clipping these coupons 5 years after you
Exactly.
after you actually
Yes.
made out
Yes, some good
Exactly.
cash, yes, and then you decide to say,
Exactly.
I'm going out.
exactly
Okay.
you
Okay,
can
thank
yeah.
you. Yeah, okay, thank you,
know.
sir.
So
Yeah, thank you.
it's not a problem. What's the hell is that?
It's a movie lecture. It's about, I think, how to make
What
movie
lecture?
movie script or something like that. I guess that's what sometimes they have.
If I were you, I wouldn't wear this hat.
Why?
Because it tells me that you are a benchmark hugger.
Actually, we matched almost the benchmark.
Of course you did.
But my pick was the best performer in the thing.
Good job.
I was lucky.
Good job. Okay. I have a friend, he has a hedge fund, right? And he actually basically wrote, in January that commodities are going to outperform the stocks. I mean, he couldn't be more, more clavier-aunt, right? More profit than that. In January, he made, his return now is like 25% for the first 3 months. It's something crazy. But of course, he didn't know about what would happen at the end of February. It was just a lucky guess, I think. Okay, is this clear?
Yes, it's okay.
And now, let's do this. I want to see the volatility service. Yeah, and that's a swap curve here. Let's see. Yeah, volatility comparison. Yeah, volatility OVDVS. Ah, this is a nice picture. And I want the surface. No, it won't. Oh,
Wow.
what is this? Anybody can tell me. So these guys, right, are the swap expiries. Okay? And these are the different strikes. At the money, right, is basically an option where the swap rate equals to the strike rate. So if you have a 10-year rate, right, is it, oh, this is going to be, no, this is not what I want. This is this a foreign currency thing? Yeah, seems to me like a foreign currency thing. Let me just, USSW5 options. No. Okay. No, this is the first one. Where is the swap? Oh, here. Here's the swaption. Okay, good. But this is the SOFR. Okay, so let's look on this one. Maybe a 10-year. Okay. This is so I want the description. Okay, so a swaption, right, is an option to enter into an interest rate swap. In exchange for an option premium, the buyer gains the right, but not the obligation to enter into a specific swap agreement with the issuer of a specified day. You see, so it's USSNA 101. This is a 10-year. This is an option on a 10-year swap. And what I want to do, I want to try and do OVDV here. And I want to see if it will give me the volatility surface. Okay, let's see. Oh, this is still, shit, this is a Euro USD. This is a Euro USD. I'm not sure why it's not giving me the, oh, maybe it's this. Oh, no, data unavailable. Maybe it's not supported here, you know. Oh, let's see volatility comparison. Now you see it's not supported. So maybe the fixed income thing is not supported. Okay. So now what I want to do before we go to Excel, I want to look on the command on the credit default swaps. WSDS, I think. World CDS monitor. Click. Okay, so what are those, right? These are like the God's eye. For each name here, and you have a lot of names here, okay, you have basically a credit default swap. So for example, if we look on an insurance company, which is called Assured Guarantee, okay, and you can look on the price graph, no? You see, this is basically the credit default swap for this company, Assured Guarantee. This is a 5-year swap, and this is a SR. What does it mean to have SR? It's a senior debt, right? So Assured is a big insurance company. It can have different layers of capital structure. So you have the top bonds, the top credit bonds, right? And then you have the bottom credit bonds. And the top credit bonds will be paid first if, God forbid, Assured is going to be in some sort of a deep doo-doo, right? So what you see here, okay, is is a price which went from 77 and now it's 79, so it's barely moved, right? It's barely moved because you see it's pretty stable. However, it was in its peak on March 23. For some reason, it went to 87. Okay, so if you want to see the calculator, you do CDSW. This is a swap calculator, right? For Assured Guarantee. This is a swap curve. You can see here that for 6 months, okay, you have a 6 months credit default swap on Assured Guarantee with 33 basis points. So if you are going to pay, right, and you're paying semi-annually, you're going to pay on $10 million, how much you're paying? As a buyer of credit default swap, you will pay 17 basis points, right? So it's 10 million times 17 basis points is going to be $17,000, okay? And if you go up, for example, here, right, this is a 5-year swap. This is the most kind of traded thing. This is going to be 75 basis points, right? So when you buy a 5-year credit default swap, you're going to pay 75 basis points per annum on a $10 million. Okay, you're going to get it's going to be $75,000. Divide by 2, 37 and a half, right? So I'm a seller of this credit default swap for you, right, lady boss? You will give me a big fat check of $37,500 until maturity. But you will never ever hold it until maturity, and I'm going to explain why not, because you are actually going out. Now, you see how this credit default swap are traded is very interesting. So the coupon is always fixed. The coupon will be 100 basis points. So if you are a buyer of a credit default swap, right, and it's actually 77, nobody is actually going to pay 77 basis points on $10 million. You will always pay 100 basis points. Okay, and where do I see that you pay all 100 basis points? I need to see it somewhere, and I have no idea where to see it. Somewhere here. Let's see, where's 100 basis points? Anybody can see here 100? the coupon is 500 basis points, you see? This is the coupon that you're going to pay for this company. And the frequency is quarterly. Now, if I will drop it to 100, probably it's 100. This is better, okay? Because this is probably, what is the rate of assurance, I don't know. But because it's an insurance company, it must be at least triple B, otherwise it's junk, okay? You see it's that you can pay only 2 coupons, lady boss. You can pay either 100 basis points or 500 basis points. So if you're buying a credit default swap from Yaakov, right? How much you're going to send me every half a year? With 100 basis points. How much you will send me every half a year? No, 50,000. Right? Now, the coupon, right, which is fair, is 79.55, right? So the coupon which is fair is 80 basis points. This is interesting, right? You are supposed to pay 80 basis points. This is what you are supposed to pay. Yet you must pay, by obligation, right? You must pay 100 basis points. So you have 20 basis points difference that you overpay. So how do you get out of this conundrum? You understand the problem? You need to pay 80 basis points, so it's $40,000 a year. But this trade, as it trades, you have to pay $50,000 a year. So you overpay by $10,000 every half a year. So how do you actually get out of this conundrum? Any ideas? Do you understand the question? Because nobody wants to overpay. So how do you actually get out of this conundrum?
Probably have to reverse it.
What do you mean?
You become the seller instead of the buyer for a
Well-
different contract.
Well, no, you don't need to do it. The seller will give you the money. Gives you the difference. Isn't it crazy, lady boss? And how much I will give you? I'm going to give you $119,213. Sorry, yeah. Yes, that's the price. The price is exactly how much I'm giving you. Okay? So the seller will give money to the buyer. It's called points up front here. You see 19 basis points. The seller gives money to you. So you give me $50,000 every year, every semi-annual, right? I'm going to give you back up front 19,000, whatever. 19,000 times 10 million, I will probably give you $19,000 up front or something like that. You see how it works? Basically here, right, I need to actually calculate the difference. The difference here is 20 basis points. But you want to take this 20 basis points, and I need to give you it up front. I need to give you a big fat check up front. So you're going to be very happy, lady boss. I'm going to be very sad, Yaakov. Right? Because you are going to get money up front. However, the price that you are going to pay for that you are actually going to pay, instead of 80 basis points, you are going to pay 100 basis points every year. That's how it works. I mean, it's very interesting, and it actually was initiated after the 2008 crisis. Because people couldn't pay the coupons, couldn't pay those crazy coupons, right? So basically people said, okay, we're not going to do it anymore. You're going to have a very predictable payment stream every year, 100 basis points or 500 basis points, okay? And everything will be settled up front. Isn't it brilliant? This is financial engineering at its best, right? Everything is settled up front.
Meaning the seller pays first.
Exactly. The seller pays or the buyer pays. When will the buyer pay? If instead of 80 basis points, we'll 120 basis points. So then you will pay me. You're a buyer, you will pay me the 20 basis points up front. So 20 basis points times 4.5, you will pay more or less $80,000. Is this clear
Mhm.
how it works? Yeah, I mean, the fun in these instruments sometimes is to understand their mechanics. The fun in these instruments is sometimes to understand their mechanics even more, right, whether or not you are going to make money or not. Because the mechanics sometimes actually is so convoluted, right, that you need to be an expert to understand it. So when you are actually going, let's say, to a desk, let's say you're going to a credit desk, right, a lot of the traders themselves do not understand how this shit works, you know. They just trade, they just basically pick up the phones and talk, but they don't understand how it is actually done under the hood, right? So it's like you have a car, you drive a car, and you don't care about the engine. So it's the same logic. Okay? So this is a calculator, and you can see that you have a credit default swap curve. Now, we have something like that also for the index, and the index is basically is very interesting. So if you look on the CDX index monitor, okay, this is a very interesting thing because it gives you, so this, right, is God's eye. If you go, for example, to CDX investment grade, this is going to be, right, what is going to be the company rate for investment grade, so triple B and up. So you have 100 names in an index. All these 100 names are investment grade. And then you kind of trade, so you kind of have, when you have the S&P 500, which is a benchmark for equities, this is a benchmark. This is a benchmark for the credit, for the investment grade credit. So if I look and see credit default swap calculator valuation, okay, so this is going to be, well, this is a crazy curve, man. This is going to be, right, this is this is a spread. This is basically God's eye. This is probably the historic spread for the for the curve date, right? So 30th of April 26. Let's see, yeah. It is probably so it was on March 31st, right? It was 68 and it's tightened, right? So if we do historical price or GP, probably GP, right? This is basically the historical price of the CDX index curve, okay? So you can see that it's actually very tight. It was on the 3rd of April, it was 60, now it's 54, so it's tightened. What does it mean when the spread tightens? What does it mean about the economy?
It's more predictable.
No, but what does it mean when the spread tightens, right? The spread for credit default swap, what does it mean when it tightens? When it's actually becoming tighter. It's
People
actually
think it's not
improves.
going to default.
Exactly, very good, right? So it's kind of pointing to some sort of improving economy, believe it or not. Now, if you want to look what are the credit guys are thinking, let's say, about the AI revolution, you can go to Oracle. This is interesting. You can go to World CDS once again. World CDS monitor, right? And you can go to Oracle. LMNOP. So we want to go to Oracle, America's probably. Oracle CDS, let's see if we have something like that. Yeah. Here, Oracle CDS. Okay, so now you go to GP, and what is happening with with the credit default swap of Oracle. In August, right, it was around 40 basis points, where it is now. It is 200 basis points, right? What does it tell? What does it tell you about the credit worthiness of Oracle?
More risky.
Exactly. Why?
Maybe spending too much in AI and maybe
Exactly,
not,
right?
not
So
expect
this
to
is
get revenue.
exactly. So this is basically what the credit guys, what the fixed income guys are thinking about all this AI shit, right? So you have basically diverging views now, because the stock market, right, is all in an AI, but the credit guys think hold the horses. Okay, and it's not just for Oracle. We can look on, let's say, Meta CDS.
I mean, probably some of them will be winners. Just the question is which one will be there. So probably those who are selling their products like Google and Amazon.
But you know, when I look on this, right, I see that they're all creeping up. You
All of
know,
them?
yes. For example, this is Facebook. This is Meta, right? You can see that Meta credit default swap was 53 basis points in January. Now it's actually 74.
Yeah, but
Okay.
But maybe a good example would be like Google,
We can look on Google. That's an interesting question.
because Meta doesn't really sell those services.
So we can look on
Actually,
Google. I
yeah,
mean,
also-
So whatever has the cloud service, that should be probably less risky.
so we can look on Google, but Google probably will be very low risk. But it's still, right? It's very interesting because you can see that Google was, in July it was 30, now it's 50, so it's almost doubled, right?
Mhm.
From the point of view of spread, it almost doubled. Okay. So even here, even in Google, right? Now, granted, 50 basis points is not a big risk to default. Okay, but even with Google, you can see that the credit guys think, right, that this AI will not lead to any, to any tangible gains, because you wouldn't see it like that,
Yeah, the trend is showing.
Right? So there is a diverging view between the credit markets. So basically, fixed income people that trade AI, that trade those companies, right? There is a diverging view between those people and the people that are actually doing it on the equity side. Because people that doing it on the equity side, right? Magnificent Seven stock market at its peak, mostly because of mostly because of AI. So that's interesting. Who is going to win?
Yeah, but you see this, all three of the companies points, their credit default swap is pointing in the same direction.
Right. It
Increasing.
points to the same direction.
Yes.
And this means, right, that whoever trades it thinks that the risk of these companies defaulting on their debt,
Yeah,
right, increases.
exactly.
Which is kind of unbelievable if you think about it, right? Because we're looking at the most powerful companies in the world.
Exactly.
Usually,
Yeah.
fixed income guys are smarter than equity guys.
Well, I mean,
Historically, that's it.
let's look on
No, that's
something.
kind of- that's the
Let's look on
situation.
something.
That's
Let's look on something.
That's economists say.
Okay.
If we look on Abu Dhabi CDS, here, and I want to look on GP. You look what is happening here, right? Look now. Of course, it dropped. Why did it drop? Because United States bailed them out, right? Because United States opened swap lines to Abu Dhabi, and even our president was surprised. He was shocked that they came out, right, bailing for a bailout, because the swap lines are actually bailouts that you give them dollar and you get back their worthless currency,
Sorry, what are we looking at? Is Abu Dhabi?
Abu
like-
Dhabi credit default swap.
Okay, so it's a government.
It's a government, it's a sovereign, yeah.
Yeah.
So for example, you can look on Brazil CDS.
Well, Argentina's one we just bailed out about 6 months ago.
Huh?
Argentina.
Argentina, yeah, we can look on Argentina, but Argentina is very high. I think, let's see Argentina. Yeah, but Argentina is, is notoriously bad. You wouldn't think about.
So same trend, just bad.
No, that's true. They have been on it
Constantly, constantly bad.
Yeah, they have been on that for a while now.
Yeah, they were for a while, but I think now they're getting back.
Wow,
This is,
interesting.
look at this. This is, you see 600 basis points.
Wow, yeah.
600 basis points.
Yeah,
This
Wow.
is crazy.
yeah, they're talking.
You know? This is how it looks like.
They're playing big. Like,
The spread is 600 basis points.
Wow.
And you can see how volatile it is, because here, right, it's not even being traded because they're bankrupt. So they go into bankruptcy, they emerge, right? And now it seems to me, I mean, since right, so because they elected this guy, I think now they have a little bit better chance of of not getting into bankruptcy.
Can
But-
we? Can
yes.
we look at Hungary? I'm just curious.
Hungary, yeah, of
After
course.
the election, what happened?
Yeah, we can look. We can do Hungary
But that is a
CDS.
good one.
I'm curious whether it's reflected.
Right, so you can actually look on that. And you can look on GP. But they're backed by the European Union, so I don't know. Okay, you see, it collapsed. So
It's collapsed.
it was 110, and now it's 80 because of the election.
Yeah, because they accept it will be a better economy. in the
Exactly.
future.
Exactly.
Yeah, they're not corruption. They're taking the money from
Exactly.
European Union. So
Exactly.
different story
Exactly.
in economy.
So risk is reduced.
So
Exactly.
that shows actually what
Yeah.
happened. Yeah.
Yes.
That's good. That's good. Because some
Yeah.
people are like, they have this ideology and they're like, oh, talking BS. So I can show them like, okay, that's the real.
so you have got political.
Look at that chart. And
No,
and
these
the-
guys, right? These guys are actually putting
Yeah.
money where their
Yeah, he's
mind
putting
is.
expert in the position,
Exactly.
not like previous just friends who have no
Exactly.
clue what they're doing.
Exactly.
Like the economy minister never could actually really there was what is the prediction for the future? It was like
Okay.
always like totally off, like 2 times, 3 times off. Like even in the first quarter had to adjust
I see.
the budget.
This is a massive improvement.
Yeah, that's.
Yeah, this drop from 122.
What's the date on that one?
This one, this
the
is
left
the
side.
lace.
What's the left side?
This one,
The left side.
where?
The left side of the screen. That's beginning. What's the date?
Here?
No, this. What is
The
the
top.
beginning? What's that? What's the date?
Ah, you do maximum. It's April. I mean, this was April probably.
Okay.
It was April 25. I don't know what happened in 25. Why there was this spike? I have no idea. Why was this spike? I have no idea
In
why
April?
was this
April
spike. Yeah.
25.
April 25, a year ago. I have no idea why was this spike. But you can look on the maximum, right? So you go here and you look on the maximum. You can see how it's actually looked like, right? So it started with 05. Then in 08 in 2011 there was this crisis, and it
Yeah, they
Yeah.
won in 2000. Yeah, the
Yeah.
economy was in a bad shape during
Yes,
the previous. Okay, I
yes.
see. Yeah, actually,
Yeah.
it shows what happened. Actually, yeah.
Yeah. Okay. Any questions? Okay. 20 more minutes and then we'll be done. I'll be done. Okay. So now I wanted to show, and thanks for Cliff of making this happen. Right? Is a Bloomberg template library. So this is a service. So you do XLTP, right? And then you can open. Hopefully you can open this thing in Excel. And this is the best kept secret of Bloomberg. That you can actually download data into your Excel, okay? And then you can actually change, right? You can actually change the numbers. And it will actually update automatically all the cash flow, all the models. So you don't need to actually, you can actually, for example, take out the internet and when you actually will change, and you can actually change those numbers manually, and it will update. So the benchmark huggers, aka SMF guys, right? They're using this this spreadsheet all the time. Okay. And this is just one spreadsheet of many. So you have data here. This is your, this is basically you have a lot of data. And here you have you have basically an explanation of how it works. So it's actually very, very well defined. Okay, so how you go there, once again, let me show you, because I think this is important. XLTP, okay, Excel template library, and then here you have a lot of, a lot of analysis. So for example, if you want a Bloomberg company in-depth analysis or valuation analysis, you can go here, okay, and you can actually open this thing in Excel. And this is very, very, very powerful.
It's interesting. One of in our team, we ended already that 1 year period, but he has the Bromberg terminal. I never mentioned this. He
I
has a
see.
subscription for 30,000 per year.
Wow. Yeah, okay. Right, so you can actually change the ticker here. Right, so it updates. Now let's change the ticker. And I want to change it, let's say to
AVGO,
what is it? Shit.
Broadcom,
AV.
VGO.
Voila. Please wait. Tuck, 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 tuck. Right? So this is the business segments. So semiconductor solutions 42%, 58%. Geographic segments. You have it everything here. You don't need to go to Bloomberg with this, right? You download your data with at your fingertips.
So this is a macro package in the Excel?
Yes,
Okay.
absolutely, right? So you can actually go, when you go to file, you go to options, okay? You go to add-ins, right? Now you go to customize ribbon. I don't know if you can, and you do here, you probably do developer. And you can see the God's eye. Voila. So you can see these are the Bloomberg, this is a Bloomberg, right, package. Right? Let me show it again for those who are curious. You can come closer. You don't need to be there. You can come closer. So if you want to find the macros, right, usually when you go to options, you have this customize ribbon. In this customize ribbon, this is like this. So you don't see the Visual Basic, right? How do you see the Visual Basic? You go to File, you go to Options, and here, right, you go to Customize Ribbon, and you actually, where the hell is it? And you see this is unmarked, unchecked, right? You check it, like this. You do OK, and here, right, it actually appears. So when you go to Visual Basic here, you can see the Bloomberg add-ins here, the XDCF, all this, right? These are the coming from the spreadsheet. So when you load the spreadsheet, right, it actually also loads the stuff which comes with the spreadsheet. So I don't think, yeah, you see, you have to have a password. So you cannot hack it. I mean, you can hack it trying to hack it, try to break it with a password, So you create a bot that tries millions of passwords, and hopefully one of them will break this shit, But that's how it works, right? So yeah, but the nice thing about it that you can see all these numbers here, right? You can actually change it. You don't need to see the formula. You can actually, the formula actually going. You see, the formula is actually going to link it to
The macro.
to the macro in Bloomberg, right? So these are the formulas. You see BK tickers, blah 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 blah. These horrible formulas, okay, are actually telling you how you push this number, okay?
So this pulls the data from Bloomberg
Exactly.
directly.
Yeah. So for example, here, right, you can see that it's actually, let's see, where is this? Here. You see, this actually will actually pull the revenue directly from Bloomberg, right? So you see the formula. So you can use this to learn Bloomberg formulas. In Excel, right? If you have an add-in, you can actually implement your own macros.
You mean
By-
using the API?
Using the API, yeah, because you see the API is exposed.
Yeah.
What's going on there?
I don't know. Someone is going outside and the door is open.
Right? So I can actually change it to ORCL, for example. And watch what will happen. It's updating the data, right? So it's actually deploys all the Bloomberg formulas inside Excel. But you can actually see those formulas. For example, if you want to know how to get one month's revenue, right? You can actually take this guy, go to a spreadsheet here, put it here, right? And instead of a ticker, do meta and hope for the best. Voila.
And why that's going to help you is because you can save the spreadsheet. You can't save the Bloomberg spreadsheets. They're
Exactly.
locked. They reload every time, so you have to be live
Exactly.
connected.
Exactly.
So
but
this-
you don't. But
This will stay.
Exactly. This will stay. Exactly. Right. So this formula will stay. And if you're smart, what you do, you call these formulas into Visual Basic, right? You basically tell Excel at the beginning, when it's actually Excel is coming up, right? Fill in those formulas in those cells. You see, it's called on something. I don't remember Visual Basic, it was a long time ago, right? But you can actually save this formula and on demand, right? Update this thing. I can actually use, instead of meta, let's say I can do T, which is AT&T, and voila.
How does it authenticate? So like anybody can use this?
We're logged in.
We're logged in.
Oh, so
Somebody's
Excel.
logged in.
I'm logged in. Yes.
You mean
Right.
to the computer or to Excel?
No,
To Bloomberg.
to Bloomberg.
Bloomberg.
Right. So this is under Cliff's.
Yeah, but there is a separate Excel. If somebody.
I know, but it doesn't matter.
The protection's gone.
The moment he's logged in, right,
Mhm.
he can actually deploy Bloomberg spreadsheets, and he can actually deploy Bloomberg formulas. But he has to be logged in into Bloomberg.
So it means that if now you send me this Excel, I open and my own personal computer, it doesn't work.
No, it won't work because
The data should stay.
what
you can't
want-
be able to
okay,
adjust the
so
formulas
here
at
we
home.
can do this, and we can open Outlook.
I mean, the whole Excel is.
I understand. This is probably your Outlook,
Yeah.
right? So he can do new mail, right? Put here Lady Boss, do this, Control V, right? And the formula will come to you.
Yeah.
And then you log in into Bloomberg. You take this formula, copy paste, bang, it will work, right? That's how it works. And he can actually also send. Well, now he will not be able to send, right? he can actually send a Visual Basic code, right? That does, let's say, 100 things. Okay, you take this basic Visual Basic code, you put it into, you put it into your macro, right? You click, and then it can actually start pulling all these formulas by yourself. So Bloomberg created these beautiful spreadsheets. You see here, Bloomberg has all these spreadsheets, peers, indices, you name it. Oracle price versus peers and a benchmark, right? So this is how the Oracle price performs. And this is crazy. This is crazy amount of information. You see, these are the indices. This is a benchmark of Bloomberg, of Bloomberg, where it compares to the, where it compares the Oracle pricing to the pricing of an index which is composed of all these crazy companies. Look at this. This is crazy, right? But you can actually take this code, okay? Let's say, for example, these formulas here, calculate index. Oh, for some reason. Okay. See, can I calculate index? No, I can't. For some, because maybe I opened it. Maybe I opened so I don't want to open Outlook, and maybe I don't want to have a developer. Let's see. Let's see. Block content for some reason. Let's see if I go here, it will be blocked. Ratings, let's see. Okay, so where did I go? Here. So I can change it here to let's say Bombardier is B1B, like this. Okay, but these buttons, let's say, are disabled, right? You see that calculate index doesn't work, but you can see, but you can actually do it yourself. You don't need the now it's update historical data, so it recalculates the entire spreadsheet. But you can take this spreadsheet and tear it apart. You don't need all this information. So by looking at the formulas, right? You can actually create your own spreadsheet, which might be lighter than this spreadsheet.
They just have what you want in them.
Ah?
You just put what you want in them. Too.
Exactly. And you can actually use this, right, as formulas, as you actually pointed out. So you take these formulas, you save it to your, to your spreadsheet. You load the Bloomberg add-in, and then you'll be done.
The fifth optional semester, there is one class with Misha Rakamoto is teaching. He's teaching VBA.
He's teaching VBA, but I don't know if he's teaching Bloomberg attached to VBA.
No, he doesn't.
Oh, he doesn't do Bloomberg that much.
Yeah, just only the
Yeah.
models. But maybe he can be asked if there is time in that class.
Well, you can actually, ask him.
Yeah.
Right?
The way he's teaching VBA, he says, know what you want to do and ask AI how to do it. That's how he's teaching VBA.
AI?
Yeah, he shows the model, and practically even he gives you the prompt, and you just have to feed it the AI, and then if it gives you a bad result, then you have to fix it. It's
Yeah,
really-
but to fix it, if you don't know what to do, what you're doing,
he's
how to
helping
fix
you.
it?
The prompt
do
is
you
pretty good, so there is small problems only with AI generated.
Yeah, but the problems, if you want to fix it, you need to understand what's going on, no?
Yeah,
I don't
but
know.
he's helping you.
He's helping you. Well, it's useless,
Semi-useless. Yeah.
semi-useless. The way I'm teaching it is more useful, I think. But who knows? Maybe it's not as well. Well, at least you know some R.
I think there is a login issue.
Huh?
Yeah. I mean,
Login issue.
no, I guess it's not updating, and I don't know what it means. What it's security and
Yeah, I don't know because maybe the security is
Yeah,
not good.
yeah.
Let's look on Oracle. Maybe it will be better now. Yeah, it's better.
Okay. That's,
Yeah, you see. Requesting data, it fills in, everything's fine. But you can see here, right, that it's also, here I can actually change it, let's say to XOM. This is, I think, and you can see exactly how total return, 1 month, blah, 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 blah. whatever.
Because what you can do is you just copy that formula down for the 30 stocks that you have and just change it. It's gonna update automatically anytime you open it.
Exactly. Exactly.
And to get stuff off here, you have to use a separate spreadsheet. Because if you use their spreadsheet,
I
it
know, but you can
recalculates every
actually
time.
right, but you can create a new one,
Yeah.
right? You have a new Excel.
Because if you try to email their spreadsheet to
No,
you, it
don't
won't
need-
work.
No. What you want to do, you probably want to do this options, and here you go to add-ins, and here you want to see Excel add-ins go, and you want to have Bloomberg Excel tools, okay? And now you want to try your formula here. So where is this layer? Let me just copy sheet 1. I'll copy this formula, and let's see if it works, right? So it's a new spreadsheet. And I'm going to open, sorry, and I'm going to take this formula, and I'm going to copy here. Oppa. Doesn't like it, but I actually, why not? Because I gave it add-ins, I gave it a Bloomberg add-in. So I'm surprised we didn't. Maybe I need this, all of them. No, doesn't like it. Shit.
Or did you try to remove some space in front of the equal?
Ah?
Can you,
Oh,
can you try? I don't know if any
What?
space in front of.
space?
No. In
Try
front.
to remove. Yes.
Remove the space.
This?
Front of the equal sign, that's what she's trying to say, if there is any
I don't
space.
see. No.
I
don't
think it's
think
probably
it's-
because in that like original spreadsheet they just already input
Yeah,
the data but
yeah.
didn't show up.
Well, you have a function builder. Let's see. You have a function builder here.
Maybe they build a BQL.
Yeah. Yeah, you have a. Yeah. You see, it tells you BQL builder. So it does give you also tools to build the macro, right? When you have a BQL builder here. So if you do a function builder, right, it will give you the Bloomberg, the Bloomberg builder. Okay? So it's very, very powerful, and thanks for Cliff that enabled me to actually show it. Okay, for me, this is kind of the most important thing. This Bloomberg app, because people are usually using Bloomberg app more than the Excel add-in, more than the Bloomberg itself, because it's actually very convenient for if you're on a desk, right, you can open a spreadsheet.
Look how much
and
quicker
type.
it is.
Yeah. Then to
Once you
do
make
it
your own
manually,
spreadsheet,
right?
yeah.
To do it manually, right? You need to go to Bloomberg terminal and start monkeying with the with the functions. Here you just open and bang, it gives you everything in the palm of your hand. So I don't know if the SMF guys, aka benchmark huggers, actually use this application or not.
No, he
But in
didn't
stores,
use that.
but in stores there is undergrads are using it all the time.
There's another Bloomberg office in here?
Yes, in the library.
Okay.
Right, so this is not the only one, there is one also in the library.
This one's broke. I gotta tell them that this one's broke.
Well, okay, nobody
Startup.
uses nobody actually has, nobody actually uses Bloomberg in this campus anyway, I think. You'll be the first one to use it, if you start using it,
I saw already graduated students coming back and using it.
Graduates? Yeah, I know, because they actually went through my course probably. But in the library you have another terminal, and usually it's empty.
Okay.
So you go there, you play with it, right? And then what you do, if you're smart, when you're looking for a job, just put it in your resume that you know some Bloomberg. And they will ask you a couple of questions, right? Easy questions. How to access the terminal, if you know something about Bloomberg QL, which is the formal builder, and they will be very happy if because the problem is that every time they get somebody, which is kind of new, right? They have to retrain him, and it costs them a lot of money, you know. So if you're already coming with some sort of a background, you're a much better candidate, even if even if you graduated from UConn and not from Harvard, you know. So it's something to think about. I mean, I would actually recommend, if you guys are serious to pursue a career in the financial services, I would actually, a serious career, not, being sales in some insurance company, but, something like tangible, right? You want to actually use this application,
Absolutely.
So you have another month here? When are you guys graduating?
No, end of the year.
December this year.
December.
And
Okay.
this season.
For me, it's 2027.
Because you had the fifth semester. Okay. So you have another year here. Yes.
Professor, do you recommend the extra semester?
It's honest.
Yeah.
I think it's a waste of time.
Thank you.
But now you go and you will tell them that I told you that, right?
I mean, I wouldn't.
I mean, by the way, the test next week is next Thursday, right?
Friday, you said.
Is it
No,
Friday?
it's Thursday.
Thursday or
No, no,
The
May
8th?
8th is Friday.
It's the 8th.
No, but I mean, I think it's.
I believe.
You said Friday.
Thursday.
I mean, did I say
Thursday.
Is it not the 8th?
Earlier, right?
it's Thursday or Friday?
Friday, you said.
I said Friday. Doesn't mean that it's Friday.
That's when the final exam schedule is.
The final exam is Friday. Are you sure?
Yeah, because.
You said that.
Thursday is
That's how
May
it was
8th.
scheduled. But
Because I thought it was scheduled on Thursday. No, I looked. Let me
Okay, you
just.
change
Is
it.
it
Just
not
make
the
sure.
8th?
I didn't.
I
No,
don't know,
didn't.
but we specify the dates.
Yeah,
It should be
May
the 8th.
8th.
Yes.
May 8th.
May 8th.
Yeah, I know, but
Friday.
But
Okay,
can you
let
adjust
me-
that on Thursday?
let me
Anyway.
just see. Yeah, let me just see.
Seriously?
I want to see when it is. When is it?
Final exam.
Because you have this Chinese guy that always gets 100 and never comes to exams and to
Oh
classes.
yeah, that guy was in our capsule and we never met him.
Yeah, I know.
mysterious guy, invisible man, invisible Chinese guy.
Weird stuff.
Why doesn't it let me in? Oh man. Shit. Okay. Let me just open my phone. Let's see. And they want okay, student admin, not now, and where's my faculty center? And they want to see the exams. Oh, you're right. Shit. From 8 to 10?
No, not my class.
No, this is a different. No, where is it?
Above that one.
This one?
Yes.
This
you
is this is a class, right?
see? Yes.
Oh shit! It's Thursday.
Yeah. 5:32.
So maybe you got confused last time and you
Yeah,
mentioned the other class.
I got very confused.
So 6 to 8?
So you just make an announcement.
No, it's on
From
the,
7th to it's Thursday, 2026. Yeah,
Yeah.
but
That's good.
I have I have an exam in.
Friday?
No, I have an exam in stores between 3:30 and 5:30. So I can't, I don't think I'll be able to make it half an hour from stores to here.
So it's online.
So you probably will be proctoring with somebody. So yeah.
Why?
Somebody
It's
else
not.
gonna be there?
I won't be there. No,
Somebody else gonna be
somebody else. Yeah, yeah. But I'm going to be on the communication. So if there will be any questions, of course I'll be available to answer.
So it will be from 6 to 8 or 6:30 to 9?
What room is it in?
See, okay, so it's downtown 134.
That's the regular
Same
classroom.
room, yeah,
Okay, yeah.
yeah, and it's between 6 to 8 on Thursday.
To 8 on Thursday.
Yeah, yeah, Lady Boss, you're right. I thought that this is this. Thanks for letting me know.
So I can fly to Hungary.
I have to cancel my turn to New York.
You can go to New York on
No,
Saturday,
I
on
cannot.
Friday. Why not?
I cannot catch up with this.
With what?
Oh, I have to go to New York for my passport stuff, and I cannot catch up to go back at 6. It's fine, I can cancel it.
No, you don't cancel.
No, what time is your
Take
appointment?
online, take online.
What time
no,
is
no,
your
no, no,
appointment?
no. No, don't cancel. Don't cancel
It's fine,
passport.
it's fine.
No. That's a bad idea. That's a bad idea. No, I just take it online, okay? And let's keep it hush hush. I mean, it's better to be in person in class. But if you know, but no, if you have a good reason, right? Like a guy needs to drive, I don't know, 3 hours to class, right? I mean, if you have a reasonable reason, you know, you may actually email me in private, maybe, you know, and maybe we can discuss whether you want to take it online or not. Right? She has a reason because, you know, if she's going to cancel this appointment, she's not going to get another appointment in a month. Right? So she won't be able to go back to her home.
No. I'm renewing my passport. No, my passport is missing, so I'm just renewing it.
So it's even bad. It's even worse because you cannot get out of the country without the passport. Yes.
So it's May 7th at 7,
No, it's between 6 and 8.
6 and 8?
Yes,
Okay.
that's according to this. Yeah, I got confused last time. You know, because I looked on FN3, I looked on my fixed income on my derivative class in stores, right? And I saw that it's also, you know, but then Lady Boss now alerted me that it's actually
There's a lot
on
on your
Thursday.
plate, Professor.
I'm teaching 5 courses, man.
That's a
No,
lot.
that's what I'm saying.
That's a lot.
Yeah.
Might as well make your announcement right now for
I'm
the
teaching
course.
3. I'm teaching 4. No, I'm teaching 6.
Teaching prelis, right?
Yeah. Let's not even discuss it, okay? Let's not even discuss it.
Is the exam, are we gonna have the 2 hours or are we gonna have like 3
No.
hours?
Yeah, you will have as much as you need. Okay, I'll tell the proctor not, you know, to stay there another half an hour, it's not a problem.
Okay.
Okay, absolutely not a problem.
What is the high frequency trading class about?
Oh, that's a high frequency trading class. I'm doing technical trading. I'm showing them how to implement technical trading
Your mechanical
strategy.
analysis?
Technical analysis, and then I'm doing pair trading, and then I'm covering little bit artificial intelligence, how neural networks are working, and all that.
And is it for what kind of students this is?
It's undergrads. Yeah.
It's a 3-credit course like
Yeah, it's a
yours?
3 credit. Yeah, and it's packed.
And
I mean,
is it online or in person?
No, it's in person.
In stores?
In stores. Yeah, when she was, I think it was halved. So when they actually were undergrads, some of, you know, the domestic, no, he was undergrad.
Oh, I didn't go to UConn.
You didn't go to UConn? I was sure that you were in my course.
No.
I mean, she was in my course for sure, and I think the
I
other,
was not.
you weren't?
No, the girl that you're referring to is not here right now.
Oh,
The other one, okay.
the other one, Leah.
Yeah.
Yeah, here today.
Yeah, I mean, I always get confused between you ladies.
At least
So-
one of you were like
The 5th semester course I took this semester with Ed, he talked about pairs trading and some of the other stuff that you're talking about.
Yeah, the pair trading is
financial
actually
modeling course.
co-integration.
Yeah.
Yeah. So I do with them some of this stuff. You know, but
And the other
I'm
stuff
not
was
on
like an
level,
econometrics 2 course.
I'm not on the level of Ed. Ed is actually an animal. I'm not, you know, he's actually much better than
And
me.
do you also showing the programming part or like?
Yeah, I can show you the program. It's like, come on, man. Here's the program. You want to show the programming? Here's the program. And then I go home. I'll show you the programming and then I go home, okay? Deal?
Yep.
Shh. Okay, so you want the high frequency trading, but do you know what happened with Preli, right?
What?
What happened with Preli, right?
No.
No, what's wrong?
mind.
Some people know, some people
We
don't.
know what happened, but we don't know the reason.
Well, we know somebody knows the reason, but we don't want to discuss the reason because it's.
Will we know eventually?
You will probably.
Okay.
Yes, you will.
He's still on the schedule to teach for the fall.
Oh, you
He's not going to teach.
I don't think you're gonna see him back here
I
at all.
don't think. Yeah, he's not going to. I
No,
Yeah,
don't
he
for-
packed. I saw his office. He packed.
Not with the bail amount that he got.
Oh, yeah, he is. His
Ah, you
office
saw
is
it?
there. You just-
How did you find out?
To the court records.
Yeah, how did you find out?
Somebody told me about it.
Wow. Okay, I mean, it's not my course, it's Michelle's. For some reason, it went to Michelle's. It's Cliff. It's because it's Cliff.
Well, log me out and log in.
No, it's okay. I mean, I don't want to do it. All right, guys. So I think I'm done for today. It was great to teach you, and hopefully that you learn something from Yaakov.
Oh, yeah.
You know.
Thank you. Thank you.
So you are not going to teach us anymore? That was the last one?
Yes, that was
No
the
other
last
time?
one. You won't see me anymore. You saw me
We're
two.
gonna see you in
2.5.
Oh, for me,
You will? How?
Yeah,
In
we'll stop by and
stores?
say hi. We're gonna come to stores.
You to graduate?
Yeah.
When are you coming?
December.
Oh, December. Okay, so you. But you have something in May, no?
Yeah,
Some
the commencement at store is in stores. If you graduate December or May, the commencement.
The commencement is in stores in December.
No, in May for both
In May.
December and May graduation.
So you are going to do it with the undergrads?
No, it's a separate.
When do you have your party?